Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending March 17, 2023. So happy St. Patrick's Day to everyone out there. I'll be talking about banks today and what's going on in the banking sector. And first, this is not 2008 all over again. Remember that in 2008, what was behind the financial crisis was that banks, especially in the U.S., that was the epicenter. They had some toxic assets within their capital base, which was coming from the housing bubble, and banks were lending money through mortgages to people that had no business having big mortgages on such houses, because they were the access to credit was very easy. You didn't even have to produce any proof of employment in some regions to get the mortgage, and everyone was thinking that housing prices, they go up forever, and banks, they lent money to mortgages. They took their mortgages, securitized them, put them on the market, wash their hands of any of the risk. The risk was in the financial system, and when the housing bubble crashed, well, you have those issues. So let's not make the complete history lesson here, but that's not the case. Now the banks have lots of assets. The assets are high quality. They're U.S. treasuries in large part, long-term names. So the risk now is that it's interest rate risk. We had lots of money injected in the economy during the pandemic. After that, banks are flush with deposits. They need to do something with those deposits, so they put that in a capital base that had a lot of safe assets, long-term treasuries. And when interest rates rise, the price of long-term treasuries fall, and that created the mismatch. And to understand that dynamic, there's an economic and finance 101 episode just on that on the ia.ca/economy webpage. You can go listen to that if it's of interest to you. And the second message is that Canadian banks are not part of this turmoil here. More on that in a few minutes. But the banks in Canada are very well regulated, very diversified, and they're sound. So it's not an issue at all here. So let's start with the look at this week's markets at the close on Thursday. So very negative for the long index, minus 1% on the week. Negative for EFI on the week. Negative for emerging markets. Positive for the S&P 500. Positive for NASDAQ. Very negative for oil. So all over the place. Here, this picture is hiding the fact that there's a lot of volatility in the backdrop. So week to week to week, we could see lots of black and lots of red on this here. But I think the message sent by the oil market is very important now. All of this is, of course, not positive for economic growth. If banks are having some issues, lending standards will be tightened, and that means that the credit cycle will slow down, and this is not positive for economic growth and growth in earnings per share moving forward. So it might not be positive for equity in the long run. In the short run, volatility. In the long run, the prospects for equity maybe just took a hit too. But as we can see in the chart here, the previous picture is hiding a very volatile backdrop. You have the VIX in blue, so the fear index in equities popped towards 30, fell down, but the gray line is the same kind of index but for bonds. And the moves that we saw this week, moves of about 50 basis points in a single day on a 2-year rate. You have to go back to 1987 to see something like that. So it's not something that is common, let's say. So the market reaction was pretty strong in treasuries, because the question is, what will central banks do now? And we have a part of the answer. Because the European Central Bank yesterday on Thursday decided to still hike by 50 basis points, so still go with a jumbo hike, because they have other tools to address the liquidity issue and the financial stability issues in banks. But now that, as I mentioned earlier, we're in a world where banks are flush with interest rate risk, how far can we take that statement? So far, so good. Let's see if the situation changes, because it's still very fluid. But now maybe let's go to what happened with the SVB, with the Silicon Valley Bank. So it collapsed very quickly. In a matter of 48 hours, the SVB, the Silicon Valley Bank, was bankrupt. So the authorities decided to close it down last week. And they also closed the crypto-focused Signature Bank. So when you have lots of liquidity, some emerging themes come out. We always say that they're risky. Well, that's a good example. When liquidity tightens, well, the most speculative assets can be into trouble, and crypto-focused bank went bankrupt too. All depositors will be made whole on SVB, not for all of the banks in the US, but for SVB. They're not bailing out the investors. The investors have been wiped out. They're not bailing out the direction of the management of the bank, but they are bailing out some big depositors, and that just creates a moral hazard, because usually, even if you're a business, if you deposit money in the bank, you're only guaranteed for up to 250,000 in the US. It's 100,000 in Canada, by the way. Anything above that, it's not supposed to be backed by the deposit insurance, but it decided to do so. So there is some moral hazard for large depositors, and maybe this is something that's going to be discussed when the dust settles here on the regulation boards. The Fed has set up a bank term funding program to deal with the run on banks, because the assets of the banks were there, but they had some issues with liquidity and some paper losses. But illiquidity is the thing that can wipe a bank like that. And the Fed wanted to avoid other failures, so providing ample liquidity, that helps. So that's the good news. Now the focus has shifted to First Republic Bank. This one also does business in California with the same clients. It's Silicon Valley. Times are good for business when interest rates are low and the economy is doing well. When interest rates rise and the economy is slowing down, that's not good for the clients. Clients they need the deposits from the bank to make payroll, to pay for expenses. And when many clients want their money, well, then you need to liquidate the assets. And this is the issue that killed SVB. Now for First Republic Bank, it started by being downgraded. It was weighing its options of a sale. But very interestingly, the big banks in the US, JP Morgan, Bank of America, Bancorp, all of these players, they decided to get together and deposit $30 billion there. So it's a deposit, just like yours or mine, just a deposit in a bank account to give it ample capital to keep it afloat. And this is an interesting development, because before there was something as the Federal Reserve in the early 1900s. This is how things worked. The big banks had to come together, negotiate, save maybe some smaller players to avoid bank runs, to avoid a loss of confidence in the banking sector. And this is exactly what they did again. And this is a very interesting development, because in 2008, one of the main takeaways of 2008 was that banks, if they misbehaved, well, there was always the idea that they would be bailed out, so they could do what they want. But now I think the message is pretty clear that they won't be bailed out, and they need to take care collectively of the risk management of the banking sector. So this removes some of the tail risk that there will be more bank runs, and it's a very positive development. The backdrop remains very risky, but in the short run, maybe we removed some risk. So this is a positive development. The backdrop here, when I say that it remains risky, is the US banks are still flush with interest rate risk. And this is what I was discussing with SVB. The banks invested in long-term treasuries. This is just, on paper losses. And when you hold a long-term bond, you're going to be getting all of these coupons and your principal in the end, no issues. But it's the mark to market, so the volatility of the value of that bond through time, which is usually just kept on paper, so it doesn't really matter, until you have to sell those bonds to repay the deposits of your clients. And on the right, the Fed was very clear about that in late 2021 in its annual report, that there's a lot of mismatch, a lot of interest rate risk, meaning that people have deposited lots of money. So banks have deposits that are short-term on one hand, and they invested that in a long-term product. So when interest rates move, you could have some issues, some mismatch. And this is the thing that blew up for SVB, and the thing that would be risky, that remains a risk for US banks, Now the regulators have acted. Now banks are helping one another out, but it's still an issue. It's still big. It still needs to be monitored. So liquidity injection from the Fed, well, they undid 4 months of quantitative tightening in 1 week because they reopened their program. Banks used that to make sure they had lots of liquidity in their books. So they used the facility to make their assets more liquid. And, that was a spike that was bigger than in 2008, bigger than in early 2020. So that shows how serious the situation was. But now they acted. So it's still a very fluid situation. We don't know what next week is going to bring, what next month is going to bring, but so far so good in the reaction of authorities and helping at least limit or contain what was started as a bank run on the US regional banks. Meanwhile, in Europe, Credit Suisse is again in trouble, so Europe is dealing with that. The biggest backer of Credit Suisse, a fund from the Middle East, said that it can't put up any more cash, so it was not supporting the bank anymore. So on the left, you have the CDS spread, so it's the insurance product that you can buy to protect yourself from the failure of an institution. So price went up means that people were very worried that Credit Suisse was going to go bankrupt. And on the right is the share price, which fell pretty quickly. Of course, Credit Suisse has been a bit of a bad student in Europe for a good while. They paid lots of fees for penalties. They were invested in things that blew up. So they were in a precarious situation. But they're a globally systemic bank, and so that means that if they go bust, could bring some other players with them because of counterparty risk. So it's always a situation that needs to be monitored. But the ECB, the European Central Bank, saw the situation, heard the national Swiss bank say that they would be supportive of Credit Suisse, and that means that they still decided to go ahead with the 50 basis points, so they were comfortable enough for that, so which is a good sign. And another good sign is that European banks are in good shape. This is limiting the risks of contagion. There's always risks, but it's limiting that. On the left, you see that the bank loan to deposit ratio remains very low, which is good. More deposits per loans. And on the right, the capital ratios are very high. They were moving higher over the last few years and were very far away from 2008. So the banking system in Europe is strong. But again, it's always the counterparty risk and what might be hidden in those books. Canadian banks now, they're very solid, they're very diversified, they're well regulated. And here, the unrealized losses on debt securities, well, you see the big red stick here, this is SVB, and it's over 100%. So the unrealized losses were bigger than the capital that they held to service their clients, which means that they went bankrupt. Look at the Canadian banks. I mean, of course, there's some interest rate risk here too, unrealized losses. Interest rates went up for everyone on the planet, but look at how small it is for the big six banks. So there's no issue with our banks. So it's not a problem that is as rich or short at all. And Canadian banks have more liquid assets on hand than needed, as you can see in the second chart here, which compares favorably to global systemic banks. So liquidity coverage ratio, it's if you look at the needs that you have for the next 30 days and the liquid assets that you have to pay for that, well, the Canadian banks are well above 120% for most of them, and they compare favorably to the red stick, which is the US banks that are considered global systemic banks. So the Canadian banks are even in better shape than the global systemic players, which are even more regulated and kept a tighter eye on. So Canadian banks are in good shape. The Canadian economy is in good shape. This is some specific examples in the US and Europe. Could become something bigger if we're not careful, but everyone reacted quickly in the authorities. Here at IA, we had no exposure in the retail bond funds to any of the names here. Some exposure to some of those margin players, but marginally in some equity funds, and we've managed all of that. So no issue for the funds that we managed. And In the diversified funds, the mandates that we manage as a team, the asset allocation team, we were underweight equities coming into that. We're still careful. We remain careful because the macro backdrop remains risky. When you raise rates as much as the central banks did in 2022, you could see some shock waves through the year. So when we do see buying opportunity, we'll be the first to tell you. But we didn't feel the need to do anything special over the last week or two based on everything that's going on here, because we're already positioned more defensively in our funds. So no change here. So very fluid situation. Next week we'll be addressing that some more. You can count on us to keep you informed, but so far situation is getting contained, which is good. So what to watch next week, we'll have inflation in Canada and retail sales. So we'll see if Canadian inflation also picks up, just like we've seen in other places around the world on a month-over-month basis at least. And in the US, we'll have the Fed decision. 25 basis points hike is expected. It's going to be very important to listen to what Mr. Powell says next week. That should be market moving, and durable goods orders. So that wraps it up for the week. ia.ca/economy. You can subscribe to the newsletter. The podcast in your interest, we recorded an episode exactly on this, pretty much the same content as here, but in podcast format. It's going to be available next week. So if you like podcast format, if you want to share that with your friends, it's available on Apple, Google, Spotify, the webpage, the IA webpage. So you can share that. And Economy Finance 101, new material coming, social media, LinkedIn, Twitter, you can follow us there. So thanks for everything, and I'll see you again next week.